So we've learned how to make journal entries. We learned how to put together T accounts. Now it's time to make a trial balance. So what is a trial balance, and why do we even care about this? So a trial balance, we're basically taking a list of accounts. So accounts receivable, cash, accounts payable, all the different accounts that we have. We're making a list of these, right? And we're going to go ahead and list them, and we're going to list by, so we got debit and credit. We're going to have two columns. And then, so accounts receivable, it's an asset. It's going to have a debit balance, whatever that balance is, as of a specific date. Let's say December 31st. So we're going to go ahead and say, okay, as of this date, what is the account receivable balance? And then we're going to input it there. And ultimately, every account will be represented, and we'll have a different balance everywhere. And we'll just have these two columns of debits and credits. And ultimately, we want to see that these two columns equal each other. Now, what is the usefulness of this? Why do we care? What's the use? Well, ultimately, what we're trying to do is verify that debits do, in fact, equal credits. Right? So after we've listed all the accounts and we go through, if we see that these two columns do not equal each other, then we know that we made some mistake somewhere along the line with one of our journal entries. And so when we can kind of root out and find out what went wrong and go back and change it while there's still time, and then that gives us so a cleaner trial balance that equals, and then we're all set to start putting together some financial statements. So how do we go about creating this trial balance? Well, it's actually pretty simple. Like we said, we just take the account balances as of the certain date, and then we just make sure that the two columns equal each other. So this as of a certain date is a very important distinction. Picture it that we're taking a snapshot of the firm at a certain point in time. So in this case, let's look at this Tom's Auto as of December 31st, 2015. Let's take a snapshot of this firm. Let's look at all its different account balances and see where they're at, and let's list them according to whether they have a debit balance or a credit balance. So I put together a trial balance here. You see some assets. You got cash, accounts receivable, supplies, equipment. And because they're all assets, they have debit balances. And so I've just listed, as of December 31st, 2015, I got the cash balance. That means on that date, that you look at the T account or you look in your Excel file, wherever you have the information, you see that you have $1,000 in your cash balance as of that date. So you do the same thing for all your accounts. You just go down the line, and then you've got credit balances for things like accounts payable, which is a liability, common stock, and you have these different things. You just go ahead and remember, of course, you have revenue has a credit balance because it increases equity, and then conversely with expenses decrease equity. So you just have these balances, and then you just go through and you just quite simply add up each column. So you add up this column here, and it gives you $222,000. That means that all the debits all together, you got $222,000. Then you add up this column here with the credit column, and it gives you $222,000. So what does that tell you? Well, it tells you something very important, that your debits equal your credits. So there's not necessarily guaranteeing that there's not a mistake, but if there is a mistake, at least you know that it's not in the terms of the debits equaling the credits. And now you can go and start doing things like put together adjusting entries and then make an adjusted trial balance, and then go ahead and start put together your financial statements, which is what we're going to be talking about in the upcoming videos.